This video will help you understand the tax ramifications of using UTMAs. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. In one of my earlier videos, we touched on the efficacy of using UTMAs to accumulate wealth for kiddos, whether that's by way of parents socking away money for their future, or grandparents gifting money, or ancillary family members, or whoever wanting to provide for the child. A UTMA can be a helpful bucket to park some dollars into for the benefit of the kiddo. However, just like anything you do in the financial space, there are some tax ramifications to be aware of as it pertains to funding UTMAs and accumulating wealth inside of here. So in today's video, we'll break down what you should be aware of if you're going to plan on setting one of these up for a kiddo. In fact, UTMAs have some very unique tax ramifications that you're going to want to be aware of to avoid getting a nasty gram from old Aunt Iris. So let's jump in. So as a quick refresher, UTMAs or UGMAs stand for Uniform Transfer to Minors Act or Uniform Gift to Minors Act. Most of the time these accounts are just referred to as UTMAs, but you might hear them referred to as custodial accounts or UGMAs as well. These accounts essentially serve as your classic taxable investment account, whereby any compounding inside the account by way of capital gains or dividends or interest are all taxable to the owner. The difference is, since minors cannot legally possess any money, the account is set up for the benefit of the minor, but there's going to be an adult custodian assigned to the account. Now, custodian here in this situation is not to be confused with generally who holds the investment assets, albeit LPL, Schwab, TD Ameritrade, whatever. Those firms are also referred to as investment custodians, but for the purposes of understanding how UTMAs work, the custodian is essentially the parent that's in charge of this account for the benefit of the minor. And that adult custodian serves as a fiduciary for the minor because technically this is the minor's money. They just legally can't make financial decisions on their own. Now, once the child reaches the UTMA age of majority, which differs depending on the state you're in and is not technically the age of majority in that various state, there is a difference between reaching just the general state age of majority and then reaching the state-specific UTMA age of majority. To add clarity to the confusion, I'll link below how you can find out what your state UTMA age of majority is so that you can be informed. Generally, it's between the ages of 18 and 21. And while technically you can withdraw money out of the UTMA for the benefit of the minor while they're still accumulating wealth and they're under the age of majority, that's fairly nuanced and there are some unique complications there. So we're gonna leave that for the purposes of today's video. Know that you can access money, but most of the time people just fund these and then let them compound. From a tax planning standpoint, to keep it very simple, money goes into this account post-tax. Money grows inside this account taxably, or you'll owe taxable income on capital gains, dividends, and interest in the current year. And then to get money out of this account, let's fast forward and say they've reached the age of majority, it's treated just like any other taxable investment account. If you have to sell securities at a gain or loss to raise cash, then you're going to have a subsequent 1099 and most likely some capital gains, interest, dividends, whatever, because you had to sell something to raise enough money to pull it in cash. Now let's assume the owner hasn't reached the age of majority, which is for most people why they're talking about UTMAs. What makes the taxable earnings of UTMAs unique is how they function relative to kiddie tax rules, which we'll touch on in just a quick second. Before we go there, let's quickly touch on how contributions to a UTMA might affect your taxes. Most of the time, contributions to UTMAs are going to come from other people. They're not going to come from the income of the child themselves. And giving money to someone technically is called a gift in the eyes of the IRS. And there are some tax ramifications to know about if you're going to be doing any gifting to loved ones or whatever. First and foremost, for the tax year of 2023, you're allowed to gift anybody you want $17,000 without being concerned about any sort of negative tax ramifications in your own life. That threshold usually goes up with inflation, so if you're watching this in a future year, that number is going to be outdated most likely. Generally, any gifts above and beyond that $17,000, however, will take away from your uniform lifetime gifting exemption, which for 2023, that limit is about $12.9 million. We'll touch on that gifting lifetime exemption another time, but needless to say, any money you gift above $17,000 will have a dollar for dollar subtraction from your lifetime gifting exemption. However, according to the IRS, you are allowed to combine both spouses' $17,000 thresholds to form one $34,000 threshold by way of what's called gift splitting. And in order to make that official, you'd file Form 709 on your tax return. And that's more of just like a notice to the IRS saying, hey, we didn't violate this $34,000 cap, but the way that we made it work to where maybe my wife gave more than $17,000 and I gave less than $17,000 is combined, we didn't go over that $34,000 threshold. However, if you do go above that $17,000 or $34,000 threshold, you still will need to file Form 709 because that's how the IRS tracks your subtraction from your lifetime gifting exemption. This essentially helps you build a paper trail so that if ever the IRS comes knocking, you can say, hey, while I did give more than $17,000, my spouse and I elected to gift split, and therefore I'm not in violation of any rules. Now let's fast forward and say money is now in the UTMA, and ideally it's being invested in compounding with some competent investment firm. Generally, with the compounding of a well-diversified investment portfolio that's being rebalanced every year and kind of sticking to fundamental investment principles, you will have capital gains and interest and dividends that are procured each year that you're going to need to owe taxes on in that current year. That income from the UTMA is considered unearned income to the child. And this is where those kiddie tax rules come into play. So let's jump into that. To keep it simple, let's assume the only income for the child is the unearned income that's kicked off from the UTMA. It just simplifies understanding how these rules work. For 2023, if that unearned income is less than $1,250, then you are permitted not to disclose the earnings on this UTMA to the IRS for that tax year. And that's because $1,250 is the standard deduction for unearned income for children. However, if the UTMA kicks off more than $1,250 for 2023, then some nuance sets in. So let's jump into the nuance. So if the UTMA kicks off between $1,250 and $2,500 for the tax year 2023, and the child chooses to file their own tax return, which is not common and in a situation like this probably wouldn't be recommended, that unearned income is not going to be taxable. And this is according to Form 8615. However, what most people I work with choose to do, because it's a lot simpler and probably more cost effective in the long run, is to not have the child file their own tax return, but rather count those UTMA proceeds on the parent's tax return. And you would do that by filing Form 8814. Now this does result in a 10% tax on whatever the earnings were between $1,250 and $2,500, which at a maximum would only equal $125 because the difference between those two numbers is $1,250, and then you multiply that by 10% and you get $125 of tax. So at a maximum, it would be $125, which in the grand scheme of paying a CPA to file a child's tax return and or spending the time to do it yourself or paying for another software license to do it, the math probably won't make sense to have the child file their own tax return just to avoid paying $125 in taxes. But it's good to know that you do have the option. Now let's say the UTMA kicks off more than $2,500. What are the options there? Well, the above rules still apply where the child can file their own tax return or the parents can choose to pay the taxes for the child by including that UTMA interest on their own tax return. However, any earnings above $2,500 will be taxable at the parent's highest marginal tax rate. And the IRS does this because it avoids parents transferring a substantial amount of assets to kids well ahead of their demise so that the kids could qualify from tremendously, stupidly low tax rates previously. This was a super common practice before 1986 when the Tax Reform Act of 1986 was implemented to eliminate this very strategy. And back in 2018, 2019, there were some additional options parents had relative to paying taxes for kiddos and whatnot, but all that since has been eliminated, and moving forward, these are the rules. Now there is a threshold as to when the child will need to file their own tax return based on their unearned income amount. For 2023, that threshold is $13,850, essentially meaning that if the unearned income from the UTMA is higher than that number, the child will need to file their own tax return. There's no more just using the parent's return. But as mentioned before, all that above $2,500 of unearned income will still be taxable at the parent's tax rate. And coincidentally, $13,850 is the standard deduction for 2023, or maybe not so coincidentally. So let's say you understand all these rules perfectly. However, you look back and you think, okay, so if I'm paying taxes for my kiddo who had positive gains inside their UTMA, what about when the UTMA has negative gains? Can I use those negative losses to offset my personal capital gains? And the answer to that is no. You can't use child losses to offset parental gains. However, it doesn't mean that the losses in the UTMA were a total waste, because technically, if the child chooses to file their own tax return, you can harvest those losses and offset future UTMA positive gains or any other unearned income that the child might have. And as we know from losses, you could theoretically carry forward that loss indefinitely for the child, and they can carry it forward for the rest of their lives until the tax laws change. But then we have to go back to running the math and making sure that it makes sense, because if we take the losses on the child's return, we essentially have to sign up to make sure that we are filing a tax return for them every single year until that capital loss is fully absorbed by future gains. And you may or may not want to sign up for filing every single year for the child if this was just a one-off situation. So calls to action: if you do have a UTMA, understand these nuances, or at least come up with a course of action proactively so that you're not caught off guard if you accidentally file the wrong way, especially for those who do their own tax returns. I'll link below to some helpful resources if you want to dive in deeper to what I'm talking about, but hopefully this was helpful. If you have questions, drop them in the chat below, send me an email, we'll get you squared away. Have an awesome rest of your week. We'll chat with you later. Bye.